there, Wealth Press traders, investors, subscribers. It's time for another Monday morning roundtable. This week, I'm joined by Roger Scott, Jeff Yasteen, and Adam Sarhan. Gentlemen, welcome.
Thank you for having us.
Gentlemen, I think you might agree with me that this looks like it could be one of the most exciting weeks in capital markets since the collapse of, since the Great Depression meltdown. We've got a full-on war going on between the mob versus the hedge fund establishment, and wow, looking at the action in GameStop today, we may as well talk about that because that's all everybody wants to hear about right now. GameStop came out of the chute, dove down by 30%. Now it's on the rebound. Holy cow. Roger, let's start with you. What is going on out there?
Yeah, James, from listening to you talk just now, it sounds like you're reporting on a sports game. But you're actually talking about the market. 30 years ago, 40 years ago, before volatility started, when people were commenting about real-time market action, it was like, okay, well, the Dow's up 3 points, and now it's down 5 points, and now you're talking about the stock. But my point here is I don't know if this is good or bad, or if this is the new norm. But I'm going to tell you something. This is very unhealthy for the stock market environment. I've got a lot of opinions on this, but I'll start with this. I believe there's more to the story than meets the eye. I believe that the SEC, well, I don't believe, I know, because they've been posting articles online saying they're going to do everything possible to investigate this. I know that they brought attention to the brokers because as early as Saturday, the brokers already posted restricted trading lists, and they're starting to take it seriously this week. They're starting to take it as seriously this week as I would have liked to have seen them take it last week, but they did not. So my whole view, my whole opinion on this is this is really, really bad. And I'm going to tell you, this is going to the U.S. stock market. Think about the investor sentiment. How comfortable will hedge funds and institutions feel about investing when they think that assets may be flipped at a moment's notice by some yahoos on a Reddit site? So this is not a good sign. This is not a good way to start 2021. And I think that the SEC is going to set some examples, and ultimately the retail investors, the regular Joe Schmo who had nothing to do with this, is going to be the one that's going to be paying the consequence or paying the price for this. Because just like the day trading rules, just like the 25,000 day trading requirements, which started because of day traders, the lack of the uptick rule, all of these things may start coming. The margin requirements may be inflated. There may be a restriction on how many shares could be shorted. There may be a restriction on hedge fund capital requirements. There may be a restriction on what a retail investor can do in his account in terms of short selling. The bottom line is the more restrictions that you put on the market, the less free flow of ideas the market will reflect. And that's the worst thing that's possible. So ultimately, I think this is very negative, very bad, and disrupts the integrity of the U.S. stock market.
Yeah, that's well said, Roger. Interestingly, though, I mean, you can't deny that just by virtue of the fact that GameStop's total float was shorted 136%. In other words, 25% of the total short interest was naked. And though naked short selling is not in and of itself illegal, it's a very limited set of entities that are allowed to sell stock short naked, like clearinghouses. But so that to me suggests that there is some, we need to see the sheriff come to town and clean up a bit from the old hedge fund side. On the Wall Street Bets mob side, you've got all these guys running this hugely influential forum saying, "Oh, we just like the stock." Yet they're admonishing people to hang on or we're going to kill you. Don't be a wimp. Hang on. Don't sell. If that's not financial advice, I don't know what is. And so there's definitely going to be some ass slapping example making by the SEC on that front. Adam, would you agree with that, or do you have a different take?
Yeah, I agree with both you guys. I think that this is absolutely insane would be a nice statement. And that's number one. Number two, if you look back at history, short squeezes have been going on since the beginning of time. I'm not going to go back before the last 20 years, but in the last 20 years, you had Volkswagen before the 2008 crisis. That was at one brief moment in time. It was the GameStop of the day back in 06 and 7 before the 08 meltdown. The stock soared to the roof. Volkswagen was worth more than every other car company in the world. And same thing as GameStop, just inflated market cap. And then what happened? $1 billion question. It crashed. By the way, fast forward 2 years ago, you had Tilray, TLRY, the big marijuana stock. They came out of the blue and said, oh my God, the next greatest thing since sliced bread with a little bit of CBD or LMNOP in it, whatever the hemp stuff they put in the bread. And then what happens? Tilray went through the roof. And then what happened? Shocker of all shockers, it crashed. GameStop going through the roof. Enter any reason you want, whether it's Reddit or it's Wall Street Bets or it's LMNOP. It doesn't matter. This stuff happens all the time. It's just the characters change, the faces change. It's like when you're going through a photo album, but it's the same exact behavior. You know, if you go and yell fire in a crowded theater, you get the same reaction. So these bubbles, these bursts, these short squeezes, they happen all, time, not all the time, like every single day, but they happen on Wall Street. They've happened since the beginning of time. I can go back and give you many more examples from prior decades, but there's no point. So you're in the middle of one now. It happens to capture the collective consciousness of the market, if you will. And what's happening is you've got a guy who's the founder of that Reddit Wall Street Beats thing. He bought a bunch of calls, which means he makes money if GameStop goes up. You know when those calls expired? Last month, January of 2021, in his original post, right? Well, what happened? A bunch of other people piled on, and I don't buy this nonsense of it's only individuals and it's only retail against the establishment. That's nonsense. A lot of the professionals jumped on also. You don't get GameStop from $20 to $500 in 2 weeks by a bunch of individuals buying it. The big guys jumped on it. They saw the momentum. They saw what's going on, and they piled into it as well. And then what happened? Now you've got this fever pitch, not just GME, but you've got AMC and you've got Fizz and you've got a bunch of other stocks too. And now silver's coming to fore because they have quote unquote high short interest. Eventually this too shall pass. It's another one of those. We've seen this before. We've seen it again. So anyone that's been around knows that this type of shenanigans ends not in tears is a nice statement. So like James, you just said, hold the line or don't sell. If that's not financial advice, I don't know what is. I'm of the mindset that this is a pump and dump. I mean, this guy hasn't sold it yet, but if you go Google or what is Wall Street, Wolf of Wall Street, that the guy who
Jordan
did all this. Yeah, Belfort, who did all that stuff way back in the day, and he was a criminal and he went to jail. Why? Because he would do this exact thing. He'd pump up stocks and then dump them. This guy has a bunch of calls that expire in January. All of a sudden, the stock goes through the roof. His calls expired. I don't know if he sold or he didn't sell. I don't know. All I know is that when you have a pump and dump is you do what? You have a stock, you get a bunch of people to buy it, and then eventually you sell it. Well, that looks like a pump. If it walks like a duck, it smells like a dump. You can finish the sentence from there. So as far as, I'm concerned, been around for decades now looking at markets. This is just another one of those. We've seen this before. And I'd urge a lot of caution across the board, especially if you want to buy it now. Where's your, be very, very careful. And then the final point I'd make here, James, is that the irony of this whole situation, or the funny part, is that GameStop and a lot of these other ones are actually now good shorts. And I'll leave it at that.
Yes.
Interestingly, both AMC and now GameStop have raised significant capital based on their new share price, which essentially gives them the liquidity to now seek another business. GameStop was a dying business based on the fact it was being disintermediated by the internet. AMC was being disintermediated by the internet. And now here they are, thanks to the mob, they've been able to raise all this new capital at crazy valuations. And it's like, now maybe they're going to be along here at some point. I mean, you don't know. Anyways, Jeff Yasteen, it's your turn to weigh in on this. That's what you make of it.
Well, all I can say, especially you say about those companies coming out with new offerings here. I mean, it's capitalism, at its finest, I suppose, and also at its most distorted at times, like now. I agree with Adam and Roger. Overall, a very unhealthy development, And along those lines, the thing that occurs to me is, like, over the last 10 years of this huge run of bull market that we've had, secular bull market, the one thing we haven't had that may be changing now is that typically, when the markets would sell off 10 or 20%, everybody would get really scared and you go hide in their shells, and stock prices would come down, sentiment would get really tamped down, and that would set the stage, a healthy sort of shakeout for another move higher. My concern is that with, I think WallStreetBets has 6 million people or so in it, account holders, if you can call them that.
7 million now.
Yeah, I thought I saw something to that effect on Twitter the other day. But either way, you've got millions of new young investors in there, and what they're being trained to do is to essentially buy and hold at all costs. That ultimate belief that if I buy it and we wish for this thing to happen, collectively we can make it happen. And obviously, Wall Street, the speculation game being what it is, you're playing right into the hands at the wrong time for the rest of the professionals in the market. So my concern is that when we do get a sell-off, and we might be starting to see one over the last few days, maybe not. I think we still got maybe another month or so left of sort of up and down sideways movement here. But my concern is on the next real sell-off that we get, that the WallStreetBets crowd is going to get even more bullish after we've had the sell-off. And that is sort of the hallmark of a true oncoming bear market. You have that sell-off and everybody gets even more bullish than they were at the previous top. And we might be in the process of that now.
You bet. This whole episode reminds me of the legendary war between Carl Icahn and Bill Ackman in the Herbalife thing. Remember? Bill Ackman took $1 billion short position and Carl Icahn said, I think you're wrong. I think it's a buy. And ultimately, Bill Ackman had to eat his hat. I mean, that was essentially the battle of the Titans, whereas this is more like Davy and Goliath. And, you guys are absolutely right. At the end of the day, it always ends in tears for one party or the other. And often on both sides, the casualties are, basically wipes out whole armies of traders. So, I mean, there's two things we know. The SEC does not like anybody to have that much influence over the market, and they're going to go straight to the heart of that matter by making examples of some of these Wall Street bets guys who are obviously posting very bullish views while holding a position and not necessarily disclosing that fact ahead of time in a timely fashion. And then on the other side, they've, since the start of regulation SHO, back in 2005, where they've always been disturbed by the level of abuse going on by hedge funds, clearinghouses, brokerage firms, in terms of how much the naked short selling provisions are violated and circumvented and loopholed through, and you end up with these things where you got 136% of a company's float short. It's like, it's mind-boggling. But at the end of the day, I find this very refreshing. This is proof positive that we do in fact have a free and fair market, though it might be encumbered at different times by special interests. And so, whereas many people think this is unhealthy, I'm starting to be of the view that this is a healthy thing because it's going to clear up some stuff. Roger, to your point, more regulation is always negative for long-term investors. Couldn't agree more. But isn't this sort of a situation that we kind of needed to happen? This is like catharsis of the nth degree in the market.
Well, you brought up a very good point, and here's the distinction I want to make. I don't know for sure. How can I say this in a way where I don't? Well, let me just say this. What I think this whole thing began as the way it seems with these Reddit guys with this forum. But my concern is this went on. This has been going on for a week now. My concern is that there is more than meets the eye here. That it's not just that it's just a bunch of yahoos on Reddit doing this. That there may be a conspiracy. There may be another hedge fund involved. There may be option buyers that are targeting specific strike prices. It seems like if this was going on with GameStop, which doesn't have a lot of liquidity or float, so it's kind of easy to manipulate. But even with that said, usually even with what was the Volkswagen example, it didn't last this long. The degree by which we saw it just didn't go this much. So the fact that it's shifting into other stocks, and the fact that it's been going on for a full week, and the fact that price went from what was it, $15 a share or $12 a share to $500 a share, back to $250. I think that there may be more than meets the eye here, and it might have started out that way, or it might have turned into that. But I think once the SEC completes their investigation, we may find out that there's more than meets the eye here. And that's what my fear is. If what you're saying is true, James, and if this is an organic thing, then yes, it's really good, because yeah, it'll clean up a lot of shorts. It'll allow the market to move itself forward. But I don't believe that's the case. I think that the reaction we've seen from these stocks is too much. I think that based on my experience and based on everything I've seen in the market, and again, this may be something new, but I don't believe a bunch of retail traders can create this much of an impact across several stocks and strike prices. I just don't think it's possible. I believe when it's all said and done, we're going to find out that there was some concentrated and an organized effort by a group of traders or a team of traders. I don't think it's just random guys doing random things.
Yeah.
That's illegal, it's dangerous, and it's completely manipulative.
Yeah. The conspiracy aspect is interesting to me, though. Again, it exists on both sides. There was a whole bunch of posting about silver and how silver is the next thing of Wall Street Bets, and everybody should run to silver. Then you got this faction in Wall Street Bets, and these are the guys who have the longer term accounts, who are the Redditors, saying, whoa, we're not going after silver. This is an effort to undermine the liquidity in GME by the hedge fund guys who have now infiltrated our Reddit. And so there's a conspiracy. I mean, one conspiracy, I think there's a bouquet of conspiracies underway here. You've got probably guys on the hedge funds, the quants, they're notorious. They're strictly the computerized algorithmic traders. They follow the volume. There's not even a decision being made. It's just a computer says, hey, the rate at which the bid's going up on this stock and the rate of interest means this is a buy. So buy it now and buy it for the next 5 seconds as long as these conditions remain intact. And that's probably 85% of the interest in GME. All this other stuff is ancillary to that. Is that a conspiracy? No, because they're automated algorithms that are just basically on autopilot. And in large part, the algorithmic universe has been fed by the fact that the SEC says, oh, they call you up and say, why'd you buy that stock? Did you get a tip? No, it's the algorithm. Oh, it's the algorithm. Okay, that's it. Nobody else can argue with them. So yeah, conspiracy on the hedge fund side, infiltrating the Wall Street Bet side, but also definitely other groups infiltrating and saying, yeah, go GME. And they're actually big funds that are long the thing too. And it's like, oh my God. I mean, if nothing else, this has made the stock market the most exciting thing going on in the universe today, whether you're in it or not. Geez, I don't even have a next question. It's like, I'm getting too excited over here. Okay, so we know that GME, at some point, the interest has to wane. If you're long, you got to take your profits. If you're short, you're going to have to cover. And we know that there's infiltration of the Wall Street Bets thing going on, which means there's dilution of liquidity going to happen. Some guys get in there and call for silver. Everybody rushes off and buys silver. Other guys are calling and saying, no, AMC is the ticket. No, it's BlackBerry. No, it's cost. No, it's this. It's like even a huge pool of interest like Wall Street Bets cannot withstand the diversification of interests that will happen, the dilution of interest that will happen over time, just because that's the nature of the market. The market demands that people, take money out of here and go over there. And it's, I think it's a temporary phenomenon is my point. There's all this uproar in the media about how this has changed markets forever. I don't think so. I think the SEC is going to definitely come down and rain on some parades. and they're going to take steps to make sure that, you know, these forums are think twice about promoting a stock, and they're going to make a few examples to Roger's point there. And in the meantime, you know, I think they might even tighten up the regulation SHO a bit to try and, you know, get a handle on that, because obviously at 136% short interest on the float of GME, it ain't working out that well. So great. What's my question? Where do we go from here?
Okay, sure. So it's very simple. What we go from here is we go into an uncharted territory from a pop culture / everyday Joe kind of looking at this standpoint. I feel like, and this is just my opinion, that this will pass, meaning the attention will wane. It's novelty right now. The world is captivated with this concept that a bunch of online, you know, one online forum drove a stock from 20 to 500. If you look at the last 3 days, the stock, that GME stock went from 500 to 250. It's cut in half. So anybody who bought at over 300, over 400, the stock's at 240 right now, you're underwater and you're losing big money. So the other side of the equation is the mechanics of it that I want to speak about for a minute, because Robinhood, which is one of the brokerage firms, and I have no interest here, I have no skin in the game, I have no beef, I have nothing, I'm just speaking objectively, it did something that is potentially, not potentially, they did something that's unprecedented and, in my opinion, is absolutely a big no-no. What they do last week, they said, hey, we're going to restrict our customers from buying GameStop, GME, and a bunch of other stocks also. Well, if you have to ask yourself why, do they have a liquidity crisis, which means they ran out of money? Sure, that's speculative. They borrowed on credit and blah, blah, blah. I don't care about that stuff. What I care about is nefarious activity and or illegal activity, whether it's racketeering like in the mafia or it's not. What happens is you've got the biggest platform for these millennials, which use the the Reddit thing. They're using Robinhood. Robinhood's number one in the App Store. Now, Robinhood's a brokerage firm. They let people buy stocks online. They disrupted the online brokerage industry by going to zero commission. Well, how could a company that's literally makes money from people doing transactions online charge zero commission? They do it the same way Facebook does. They take your data, i.e. your trades, and they literally sell it to the big hedge funds and the big institutions. That's okay legally. It's unethically from my standpoint. I don't think that's a good thing, but all the brokerage firms were forced to do it. They couldn't compete, so on and so forth. I'm not here to make an ethical statement on that. But what I am here to say is what happened was, who is the biggest customer they have, or one of their biggest customers is a company called Citadel. Well, Citadel literally bailed out the hedge fund, Melvin Capital, that was the poster child of being short GameStop, which Reddit had posted about and made a very big statement on. Hey, we're going after the people that are short. Melvin was short. And then the day before Robinhood banned people from buying GME, they literally put billions of dollars into Melvin Capital to keep them solvent. So what happens?
Self-interest, out of self-interest, no?
You tell me exactly, James. Think about this. You've got a company that literally pays a broker for order flow. So they could trade in milliseconds faster than you can push the order. You want to buy GME, they see that and they could buy and sell before you can even execute your transaction. The company that's doing that is literally on the other side of this short trade. All of a sudden, GME explodes like a big volcano. And then the biggest company, that's their biggest customer, Robinhood's, okay, we are going to stop allowing our customers, millions and millions of people, from buying GME. But you're allowed to sell it. What? What? Like, hello, remember in the movie Biff, McFly, anybody home? McFly, anybody? Like, wake up, people.
Back to the Future.
Yeah, Back to the Future. That is absolutely insane. And how that the SEC, the government, whatever word you want to use, or any regulatory aid, the exchanges, how that's allowed to fly is beyond me. So just today, Elon Musk and the CEO, the co-founder of Robinhood, had a little back and forth about that exact topic on social media. And Elon Musk called him out and said, listen, dude, what are you doing? And the guy basically said, oh, well, we were insolvent. We had to put money and blah, blah. It's complete nonsense. Hogwash. You mean you'd be the judge?
Yeah.
So I'll leave it at that. Those kind of shenanigans are just absolutely, that's, in my opinion, it's jail. You don't do that.
Yeah. To limit buying and not limit selling is clearly a bias. And that's just like, oh my gosh. So Jeff, where do you see us going from here?
Well, I mean, if we're talking about the markets, I think there is sort of a heightened risk level. Again, and like I was saying earlier, I don't expect the markets to head, significantly lower. I think we're still in sort of a reasonably strong, historical seasonal period, of the sort of November through March period where the markets tend to do well, regardless. But speaking to like Adam and Roger's point here and yours as well, probably under almost any prior administration, Republican or Democratic, this sort of thing might have been sort of looked past. But I do feel like, this offers the incoming administration here sort of, carte blanche to really sort of take apart a lot of these things that, as Adam was speaking to, especially, have been sort of taken for granted on heavily shorting stocks in excess of the number of shares available, as well as the other sort of behind the scenes manipulation of data and all that kind of stuff. You have to think about that sort of law of was it unforeseen circumstances where one thing gets changed over here and suddenly on the legislative rule-based side, and suddenly all these other things that Wall Street and hedge funds sort of took for granted in terms of fees and order flow and all that suddenly shrinks or just isn't as profitable. So the game shifts, the game changes, and that's one thing we all know is on Wall Street. When there's a game and it gets really popular, it's almost guaranteed that the game is then going to change. The action is going to shift someplace else to some other, to go back to a horse track sort of scenario here. They're going to start looking someplace else. So I would say just be very, very careful here going forward, because I think the game is going to change and there's going to be new winners and new losers. And, you don't want to be part of that losing group.
Yeah, for sure. Okay, Roger, consolidate all of this for us in the context of our subscribers. Should they be staying away from this action in the Robinhood universe? And if so, where should we be today?
Well, that's a really good question. Let me tie it all together for you. We are in the second week or actually in the third week of earnings right now. We've had about 150 companies report. We are still deep into it. So it's very, very volatile. And there's a lot of volatility right now in all the various sectors, because as we get deeper into the earnings season, you've got more companies reporting that are all in all various sectors. We start with bank stocks, we end with retail stocks, but in between, you've got a lot of different things. And that's what we're seeing today. Now, last week we had the biggest S&P companies. This week we have the second biggest week. The problem is the Dow Jones right now is breaking or sitting at the 50-day moving average. That's a danger zone. That's a major warning sign. And the S&P is following along. What I typically tell people is once the S&P or the Dow touches the 50-day moving average, to be careful, be cautious, and not to take position for 2 days. Give the market 2 days to go either completely above or completely below the 50-day moving average to determine where we stand. So when you take into account this buffoonery, which is what I call it with Robinhood, with the short interest, with $10 stocks going to $500, with us being in the middle of earnings season, with a potential new COVID virus or a variant that these vaccines cannot fix the way they intended to for the last year, we may be setting ourselves up for a little pullback here. Sentiment, market internals, everything is pointing to an overstretched market environment that needs a pullback. So when you take into account the current sentiment, when you take into account the fact that the S&P and the Dow are breaking the 50-day moving average, and you take that into account with all of this, again, buffoonery happening with all of these small cap stocks, it is the beginning of a very dangerous environment. My advice for traders and investors is similar to what I said a few weeks back. Shift your investments 50% into cash and 50% into ETFs. You don't want to be in individual stocks during earnings season. Otherwise, you are gambling. And I don't want our investors and traders and people following WealthPress to gamble. So either stay out of the market, lower your exposure, put some money into bonds in case the market breaks the 50-day moving average and starts heading to the 200-day moving average, because bonds will rally. They always do. It's called flight to quality. It's a basic fundamental function of the market. And don't worry too much about this distraction with short sellers. I think it'll pass. Do not touch it with a 10-foot pole and look ahead. But again, the market is very vulnerable right now. So this is not a time to be a hero.
You bet. All right. Well said, Roger. Gentlemen, a rousing discussion if ever there was one. I really appreciate all of your input. Great insights. I look forward to speaking to you all throughout the week. Have a fantastic trading day. Thanks for watching.